Mark, good to see you. I'm glad we get a chance to talk today because I want to ask you about the recent market volatility.
Mhm.
Concerns about a cooling US economy in early August led to a market rout with the Dow down as many as 1,100 points. Stocks and treasury yields paired some declines after service sector data came back better than expected. We know that we're going to see volatility. We know we're going to see corrections, but as we take a look at the S&P's 1 month performance, Mark, and we see red, we see green. How are you responding to this volatility that we've seen?
Well, it's interesting because really the market rotation, if you will, out of large cap technology stocks started occurring in early July.
Mhm.
And everyone was talking about, hey, there's a big rotation out of technology. It's going into small cap value or small cap stocks, undervalued stocks. And then all of a sudden we got this unemployment report, which basically cratered the market, if you will, for a
Right.
short period of time. And I tell my clients, I go, look, these corrections are normal. In fact, August and September tend to be more of the volatile months. And yeah, we've seen a big run up. So having some cleansing, selling, coming back, trees don't grow to the sky. We want to see things pull back a bit. These are normal things that happen. And this is just part of the cycle. What we don't want our clients to lose sight of is really their goals and objectives and making emotional knee jerk decisions that are really going to be detrimental to their retirement.
Right. Good point. Was this correction in part due to what we've talked about before, which is concentration risk? The S&P 500, you think it's well diversified with 500 stocks, but actually 82% of its movement is due to only 10 stocks.
Yeah, it's interesting, Aaron, because the last time this happened, it was 1973 when we
Wow.
saw this much concentration where, if you didn't own these stocks that you see on the screen, you really underperformed. So a lot of people think, hey, if I just put it in an index fund, I'm going to be okay. But yeah, you're not now, you're not diversified. So a lot of the volatility is occurring because of those stocks because they've just had such a big run. I mean, at some point, yeah, they all have great earnings, but at some point they've got to adjust. Again, trees don't grow to the sky, so some adjustments, some pullback is needed, and that's really healthy actually for the long-term sustainability of the market.
Right. So, speaking of diversification, how did a well diversified portfolio withstand that recent volatility?
Well, it's interesting because with a lot of our portfolios, what we're looking for, and we talk to our clients, the number one important thing in retirement is, well, a lot of things, but it's really minimizing losses. So, if you will, we look at portfolios and say, hey, if the market, the S&P 500 was down 30%, where do we want to be? And again, it depends on clients' goals and objectives, what their income needs are and age. But we're really seeing where with well-diversified portfolios, with the proper strategies to mitigate loss, we're incurring very minimal losses. And what that means is that those portfolios can get back to break even and profitability much quicker. And that's where we really want to be.
Right. So this is a little bit funny, Mark, but when all of this was happening, I happened to be on Google and I typed in, should I? And the first option was sell my stocks now. So clearly people were feeling anxious. What should we be keeping in mind?
Well, yeah, I mean, we need to keep our emotions out of it. I know that's very, very difficult to do. Obviously, when things get bad, what do? We turn on the TV, we watch CNBC, and we hear all the bad things because, by the way, bad news sells. I mean, people
Right.
they want to watch bad news. It's not like, hey, if they were saying people signed up to save more money, nobody would care. But we have to keep our heads about us, and really, it's going, okay, well, I don't like how I feel right now. That's an emotional thing. But do I have a financial plan? Do I have a retirement income plan? And is it going to continue to meet my goals and objectives? That's really where we should be focusing our emotions and our efforts on.
Right. Right. Having a plan means you don't have to go to Google for financial advice the day that the sky is falling. So, Mark,
Exactly.
if somebody would like your help creating that financial plan, how can they reach you?
Well, they can either just easily give us a call. Our phone number is 303 681 0113. And if you call us, we'd love to talk to you. If it's a 15-minute phone call, if you want to sit down in our conference room, we can talk about goals and objectives or whatever is top of mind that's concerning you. Or you can go to our website, McGregorWealth.com. And we do have a link in there where you can schedule an appointment with somebody on our team or myself. And again, same result. We can do a Zoom call, a phone call, or an in-person appointment.
That's great. Mark, thank you so much.
All right. Thank you, Aaron, and have a wonderful day.